When doing an income statement, there's a couple of items that we must report what I call below the line. In other words, below our income from continuing operations. And those are discontinued segments of business, as long as the segment is qualifies as a true business segment per GAAP, and extraordinary items. And extraordinary items are those things that happen infrequent and or that are both infrequent and unusual. So in this video, let's look at just discontinued operations and see how do we treat that on our income statement. So in this example, we've got Parker Company had two operating divisions. One division manufactured computer equipment and the other division manufactured office equipment, or office furniture, excuse me. Under GAAP, each division is considered separate components. The computer equipment division to date has not been a profitable business segment for the company. As such, on September 1st, 2014, the company created a plan to dispose of the assets of the division. The sale was completed on December 1st, 2014 at a price of $750,000. The book value of the division's assets was $1,150,000. The division incurred a before-tax operating loss from operations of $150,000 from the beginning of the year through December 1st, 2014. The income tax rate for the company is 35%. Parker's after-tax income from continuing operations is $380,000 for 2014. Based on this information, prepare an income statement for 2014, beginning with income from continuing operations. Include appropriate earnings per share disclosures. All right, so in this case, we're working with our income statement. And one thing we've got here is this is the Parker Company, so I am going to put a header on it, even though this is a partial statement. And this is a partial income statement. And then it is for a specific period of time. Now remember, we always date income statements for the period ended. In this case, it's for the year ended December 31st, 2014. All right. Now, normally we would start with our sales revenue, our gross profit, or our sales revenue, cost of goods sold, gross profit, operating income, all of that. But in this case, we do not have that information. It tells us to actually start with the income from continuing operations. Now this is after tax on our continuing operations. So our income from continuing operation goes in and it tells us that it's $380,000. Okay? All right. Now below that, actually let me move that over here just for appearance. It doesn't matter which column you put it in, but I just like to keep it over there for appearance sake so it'll look better. Now we need to go over our discontinued operation. Now, why am I doing a segment just on discontinued operations? When we're looking at discontinued operations, we have to look at a couple of factors. One, we have to ask ourselves, did we sell that component of business, or is the component held for sale at the end of the year? Because that alters how we treat the asset. So when we look at this, we look and see, okay, when was the asset sold? Well, this entire division was sold on December 1st, 2014. So we discontinued the segment in 2014, and we sold the segment of business in 2014. As such, we have to include both the operating income of that division and the gain or loss on the sale of that division as part of our discontinued operation. Okay, so here what we're going to do is we're going to say, okay, the income, or it could be a loss, from operations, and then we want to say that it includes, so including the gain or loss on disposal. So let's ask ourselves, do we have a gain or loss? Well, the book value of the division was $1,150,000. The sales price was $750,000. So in that case, we actually have a loss. So you would take those two and you would net them. So if you were to take 1150, excuse me, and then you subtract from that our 750, it shows that we have a $400 loss, okay? So that's the 400. So including a 400,000 loss on the disposal of the segment, okay? So not only will it include the income or loss from operations, but it also has to include that 400,000 loss from the disposal. So what was the income from operations? Well, the income from the operation of the segment was $150,000. That was a loss. So loss from operations of $150,000. Then you net that with the $400,000 loss on its sale. So in total, for this segment, we would have a loss of $550,000. So remember, if the business segment is sold, you have to include the income from the operations of that segment and any gain or loss on the disposal of that segment. Okay? Then the next thing we need to show is actually the tax implication. And in this case, we had an income tax benefit, but we're going to look at it in tax benefit or expense. Now, the reason I say we have a benefit is because anytime you take a loss from the operations or sale creates a tax savings because it reduces our overall earnings. And by reducing our overall earnings, we're reducing the amount of tax we'd have to pay. So what we would do is we would take these 550,000 in total earnings and we'd times it by the 35%. So that's going to give us 192,500 in tax. All right. Now, in addition to that, that will give us our total or our total income or loss from the discontinued operation. And we just net that, so it's going to be the 550,000 netted with the 192, and when we do that, we get a net of 357,500. So that's our income or loss from continuing or discontinued operation. And the last thing we would show is our net income. And net income would be the 380 less the 357,500. So this company made 22,500. So keep in mind, that's how we would show the discontinued operation. Keep in mind, it is below the continuing operation section. So above this, you would have all of your operating income, your other income, etc. Then you would show the discontinued operation separate. Okay? If you sell the discontinued operation, you include the operating income and any gain or loss on the sale of that division. All right. Now, I'm going to take this and copy it because our next example is almost identical. Okay, so let's go down to our next problem. And again, this is the same concept, and let me copy my header too. It's the same exact header, it's the same exact problem, except one difference. So let's talk about what that difference would be. All right. Parker Company had two operating divisions. Again, one division manufactured computer equipment, the other division manufactured office furniture. Under GAAP, each division is considered a separate component. The computer equipment division to date has not been a profitable segment of business, so on September 1st, 2014, the company created a plan to dispose of the assets. Now here's where the difference lies. The sale was completed on December 1st, 2015 at a price of $750. The book value of the division's assets were $1,150,000. The fair value of the division's assets at December 31st, 2014 was $800,000. The division incurred a before-tax operating loss from operations of $150,000 from the beginning of the year through December 1st, 2014. The company's in-tax rate is 35%. Parker's company's tax income from continuing operations is $380,000 for 2014. Based on this information, prepare an income statement for 2014 beginning with income from continuing operations. All right, and again, we've already talked about that, and we know that it is $380,000. So we're starting at the same point. There's only one difference between what we just did in that first problem and this current problem, and that is the fact that at December 31st, 2014, we had not yet sold the division. It is held for sale, but we haven't actually sold it yet. So in that case, what we have to do is we have to check for an impairment loss. An impairment loss occurs when the book value of our assets are greater than their fair value. So in other words, if you look at all the assets and you find out that the net assets has a fair value of $800,000 in this case, but you're carrying them at a book value of $1,150,000, that means they're impaired. The book value exceeds the fair value. They are not worth the amount that we're actually carrying them at. So we have to include an impairment loss on our income statement. So if the assets are held for sale, so in other words, you've discontinued the segment in a year, but you have not yet sold that segment. So that segment of business is held for sale. At the end of the period, you have to check for an impairment loss. So you have to look at the book value of your assets and you have to compare that with their fair value to see if they're impaired. In this case, they are impaired. So if you look at that, the book value of our assets are $1,150,000. Look at the fair value of those same assets and we see that it is $800,000. So that means it is impaired. So in that case, our impairment loss, we have to show on here that this includes a $350,000 impairment loss. We do have to include that. So what would we do? Well, the operating segment again had a loss of 150,000. It tells us that right there, loss of 150. We have an impairment loss of 350,000. So since that is the case, even though we have not yet sold that division, we are going to include that 400,000, or excuse me, that $350,000 impairment loss in our number. So we will report 500,000. The 350,000 impairment plus the 150,000 loss from its normal operations. Okay, that's definitely got to be included. Then from that point on, we do the exact same thing. Our tax benefit in this case, because remember, losses reduce our earnings, so the lower our earnings, the less income tax we pay. So we're going to again take that 500,000 times 35%, and we find that we get 175,000 tax benefit. So that's going to bring our net to 325,000. All right. 380 netted with the 325 gives us net income of 55,000. So notice the difference there. We did not sell the division in 2015. So for 2014, it's held for sale. When a division that has been discontinued is held for sale, you have to check for an impairment loss. To check for an impairment loss, you compare the book value of the assets to the fair value of those assets. If the book value is greater than the fair value, you have an impairment loss, and you have to include that as part of the loss from operations here. Okay? All right. One more problem, and then I promise we will take a break from this. And again, it's the same exact problem with one slight change. So just for my purpose, I'm going to copy these over to make it a little easier here in just a minute to actually go through this. So let's look at this last problem. It's the exact same problem. Parker Company had two operating divisions. One division manufactured computer equipment, the other division manufactured office furniture. Under GAAP, each division is considered separate components. Each computer equipment division to date has not been a profitable business segment for the company. As such, on September 1st, 2014, the company created a plan to dispose of the assets of the division. The sale was completed on December 1st, 2015. Again, that's next year, at a price of $1,500,000. The book value of the division's assets was $1,150,000. The fair value of the division assets at December 31st, 2014 was $2,000,000. The division incurred a before-tax operating loss of $150,000 from the beginning of the year through December 31st, 2014. A little bit of typo there, my apologies, 31st, 2014. The income tax rate for the company is 35%. Parker's income tax rate, Parker's after-tax income for continuing operations is $380,000 for 2014. Based on this information, prepare an income statement for 2014. All right, again, we're at the same starting point. We've already determined that it's $380,000 in income from continuing operations. The only difference is, how do we report that discontinued component? Well, in this case, again, the division is held for sale, so we need to do the impairment test. We need to compare the assets' fair value to their book value. So when we look at it, we see that the assets' fair value was $2,000,000. The assets' book value was $1,150,000. So in that case, the fair value exceeds our book value. There is no impairment loss. Okay, so we're good to go. In that case, the discontinued segment, we only have to report the actual income from operations. So the only thing we would show here on our income statement is the $150,000, the actual income from just the operations. You would not show any gain. You only show the gain if it's a realized gain, if you actually sold the division. There was no impairment loss, so for that reason, we can go in and just show the 150. And again, it's still a loss, so it's going to be a tax benefit. You take the 150 times the 35%, we get 52.5 in tax benefit, which brings our actual income or loss from our discontinued segment to $97,500. Okay, and our net income then would be $282,500. So notice the difference between the three possibilities. If you sell the division, so you discontinue the segment and you sell it in the same year, that is that gain or loss from the sale of that division is included in the operating income, so it is reported. If it is held for sale, you check for the impairment loss. If there is an impairment loss, you have to include the impairment loss with the operating gain or loss. If there is no impairment loss, then you only show the income from operations for that segment, and that is it. Hopefully this helps understand a little bit about how to actually report the discontinued operations segment.